Howdy, Jacob here. Today we're looking at the next company in our dividend yield screener, Company 50, ticker symbol EQNR. All right, let's start looking at some financials. So, market cap of 90 billion, enterprise value of 73.8. So, it looks like they have higher net cash than debt on hand, which is good to see. 3.9% dividend yield, so just under that 4% we're looking for. Let's see if that is reasonable for them and payout. Dividend about 10 billion. Looks like based on the most recent rolling 12 and the most recent 2 years, they can afford $10 billion payout. But if we look at the couple years before that, we're seeing just under 2 billion, 3.5 billion, 7 point some billion, 4 billion. Let's look at that balance sheet. So almost 30 billion in short-term investments, 10 billion in cash, 24 billion in long-term debt. Like to see that the long-term debt in comparison to their last 5 years on average is well under 5 times free cash flow, and pretty good, pretty solid, pretty big amount of cash and short-term investments on hand to help pay for whatever they want to do with their excess free cash flow if their cash flow isn't enough for it. And so I think we can start to get to some assumptions here. It looks like the last 2 years they've been pretty consistent at paying down debt. They've been very heavy buying down the common stock. So I've been repurchasing a lot of shares there. I think we can start to get to some assumptions here. So let's start looking at the revenue statements. Year over year, revenue growth went down pretty consistently from 2013 to 2016, and then up a little bit, down a little bit, up a little bit. Seems like a very cyclical business. Um, I've done plenty of companies like this in the past where I'll put 0% and then a 10 on the P and free cash flow just because I think the short term might be, yeah, or in the near term, not necessarily short term, but in the near term might decline quite a bit from cyclicality, but then jump back up to uh, levels more consistent to where it's at now. Balance sheet looks good. I don't see a reason to increase the discount rate beyond 15. If we look at some of the margins, obviously they've been a lot higher recently. I'm going to average it out with the pre-COVID levels that were a bit lower. So maybe let's try 8 and 10, see how that looks. I've been buying back shares a bit more recently, but um, not super consistently prior. And then as for their dividend, it's been up, down quite a bit, pretty heavily dependent on what their earnings look like. I might try to get them down to the $5 billion payout. So I think if I cut this in half and then keep that $5 billion payout, I think that's going to be a bit more reasonable. Again, the most recent 2 years, it looks like they could easily afford it. But then if you look prior to the most recent 2 years, you got to think, will this stick or not? And I'm just not entirely sure without digging into their quarterly reports and such. And so for me, I'm sitting on the conservative end of saying, let's cut that dividend in half, pay out $5 billion, something a lot more reasonable that you can afford, and then that gets us to a price where it would need to drop roughly 46% before you get a 15% return given these assumptions. So for me right now, if they have to cut this dividend in half, we're looking at a little under 2%. So it doesn't really fit very well with the screener that we have in place right now. But to me, I think this is a pretty decent company. So definitely one I just put on your general screener of companies you'd want to look at when they get to a price that looks attractive to you. So I think that sounds good. And for me right now, I'm just going to be waiting. So I hope everyone had a good time listening, and I hope you have a great rest of your day. Thank you.